The CFA Institute pretty recently published what some people would consider to be more of an opinion piece called Capitalism for Everyone. Capitalism for Everyone is a research paper by Michael Falk and Jochim Klement. They are two CFA charter holders and both members of the CFA Institute's research team. To provide a little bit of background, Falk is a consultant for wealth management firms and he's based out of Chicago, and Klement is a German who is living in London and has a background in equity research. I say this was a little bit of a unique publication for the CFA Institute because while it is backed by some data and statistics, some of the content of this paper reads much more like an opinion piece. And when you're talking about economic structures like capitalism, it almost always lends itself at least a little bit towards political discussions. So it was a little bit interesting to me that the Institute actually chose to publish this paper. It's a pretty interesting one, so enjoy this critical analysis of it, and please don't forget to hit the like button and subscribe to the channel if you haven't done either of those things yet already. I really appreciate them. Now personally, whenever I'm reading a research paper like this, I usually scroll all the way down to the bottom and read the summary first, just to give myself an idea of the direction that this paper's heading in. But for the purposes of this video, we're going to cover it a bit like a story, more so in the spirit that it was actually written in. The paper starts off discussing shareholders versus stakeholders. It immediately quotes Milton Friedman. So right away, some of the more conservative-leaning readers might start to get a little bit annoyed by it. But they quickly clarify this reference to Friedman, saying that he was not anti-shareholder, he was just more concerned with making sure that corporate leaders were not irresponsibly spending other people's money without those people's consent. Maybe think of like the executives of a corporation taking funds allotted towards pension payments to their retired employees for the future and using that money for some other capital project. Most people would agree that would be an unethical action. Then the authors start to loop in the responsibility that companies and corporations have to care for the environment, because not only do their shareholders and employees operate within the environment of the globe, but every other person who may not even have any interaction with their business, since they say that helping to maintain the environment is a responsibility of corporations and executives and managers within the corporations. They're able to make arguments throughout the paper that sort of loop that cause back in. To pause here really quickly, whether or not corporations actually have an ethical or moral responsibility to maintain the environment of the earth in which we live can become a bit of a ethical or philosophical debate. But for the purposes of this reading, I'd say it's safe to assume that most corporations out there, or at least their marketing departments, have admitted themselves that this is something that they're worried about and they care about, and they're starting to say that they're taking on responsibility, and in many cases actually are taking on responsibility towards keeping the environment clean. So even if you're someone who says, no, corporations have no responsibility to worry about that, then let's just assume we're talking about the corporations who have already themselves claimed that yes, this is a responsibility of ours, because at least we can group them into this discussion. The paper then talks about the other most important stakeholders, which is customers or clients and also employees of those corporations. So those three groups, the environment, customers, and employees, are the focus for which this conversation is based on. Closer to the middle of the paper, the authors present what I see as their core question in writing this, which is whether or not the current rules of the game, that is capitalism, provide for sustainable, open and free competition. They certainly believe that capitalism provides for open and free competition, at least in free market economies throughout the world, but again, the question of this paper though is focusing on if this competition is sustainable. The next page or two is a brief history around their opinion on what the current state of capitalism is in the United States and where it started. They say that the current form of capitalism we're operating in is shareholder value maximization, and that basically came about in the 1930s. I tend to agree with the information they gave on why that is the form of capitalism we're currently utilizing in our economy. Then they go on to argue that shareholder value maximization is the most efficient form of capitalism from an economic perspective, and therefore the most efficient form of economies in the world. They cite several examples of how the shareholder value maximization form of capitalism has resulted in almost all of the economic growth in the United States economy. It's the reason that the US dollar is the reserve currency of the world, and also a big part of why we have all the freedoms that we do in the United States. They also talk about the huge advantage to our free and easily accessible markets for investors to buy shares of stocks or funds in their retirement accounts so that they can build wealth over time and live a financially free final 30 or 40 years of their lifetimes. This is the part of the paper that some of the anti-capitalism people might start to get annoyed, but trust me, they're citing a lot of really strong evidence throughout these 2 or 3 pages where they argue about this being the most efficient form of economies that prove that it has done all of these things they claim. But then they go on to introduce a more recently established form of shareholder value maximization capitalism, which was titled and which they refer to as the enlightened shareholder maximization capitalism structure. The enlightened shareholder value maximization form of capitalism focuses on 2 key tenets. The first one is that a corporation must have one goal, and that goal must be to behave purposefully. In the paper, Klement explains a weakness of this argument, which is that now with the advanced mathematics that we're able to do pretty quickly on a computer, the regression models that we can run, you don't have to just focus on one thing. You really can optimize 3 or 4 primary goals of an organization. And just anecdotally, I think Amazon is a good example of that truth. They have the best online store, they have Amazon Web Services, and they have a great marketing arm. While these 3 business units aren't exactly 3 specific goals, they are 3 things that a company needs to be able to maximize, and Amazon does that well, so you can see where I'm going here. But they do say that the end result of typically working with this one goal mentality could be the maximization of happiness of all of these stakeholders. Again, that's shareholders, customers, employees, and general society. The second core tenet to this enlightened economic model is pretty typical of other forms of capitalism, and it says that society will benefit most if total firm value is maximized. All of you capitalists out there are probably applauding in your computer chairs right now. They cite the common arguments, which is that people want to be able to spend their money on the best goods available. That only happens if companies are competing and creating the best goods available, and also that when share prices are rising, again, people can invest their money in that and build retirements for themselves in the future. The authors then go on to present what is maybe the most important part of the paper, which is their own adjustment to the enlightened shareholder value maximization model of capitalism. They talk about stakeholder value maximization. So again, rather than just the one party being people who own this company's shares, we're maximizing theirs, but also customers, employees of the companies, and people of the general public. They say that the best example they have of this system working really well is of Germany in World War II. Maybe not all that surprising of a claim coming from these authors, because I mentioned earlier in the video that Klement is a German. I'm going to read some quote here. He says that West Germany introduced a social market system that combined free market elements with a strong social welfare system. The key to this system, and the system bridged the differences between free market capitalism of the United States and the social welfare state of France, was intensive coordination between different actors, politicians, and corporate leaders. Now, before I go on and discuss why they believe that is kind of the best form of economy, I want to say that I know this is where the conversation can get pretty ugly because we're starting to get political, and people have so much emotions tied to their political beliefs that it usually only turns bad when people start talking about these things. In a recent poll by Pew Research, they found that 84% of people who identify themselves as Republicans or conservative say that socialism is a very bad thing. In that same poll, of all the people who identified themselves as Democrats or liberal-leaning, 65% of that group said that socialism was a very good thing. So I totally understand that the authors mentioning that social welfare state of France and saying that it was very beneficial could result in some pretty emotional reactions from some of you. Because of that, I want to take a minute to give the authors credit here, because after reading through the paper a couple times, I really don't believe that much of their opinions they offered seemed politically motivated. I know that sounds a little bit hard to believe, but I'll link the paper below. If you go and read the whole thing, I'm pretty confident you'll come to the same conclusion. The reason I'm mentioning this to you is just to say to trust their research and conclusions in this paper because of its economic merits, not because of the political motivations that their arguments could potentially have, and I think you'll have a better time reading it and potentially learning from it. Okay, I'm going to explain why they said this stakeholder value maximization approach is the best. This consensus-driven approach avoids adversarial relationships that can lead to a complete breakdown of corporate activity. Then they cite many strikes of companies throughout history and how much a strike within a company really hurts the production of that company and more so that country. And additional measures usually taken when using this methodology strengthen the interests of other stakeholders. For example, Germany has strict separation of management and governance. Members of company's management board are not allowed to serve on its board of directors. The role of management is solely executed the strategy of day-to-day business. Meanwhile, the board directs big picture decisions. And they say that the structure results in far more effective decision making in terms of maximizing the value of public interest, but also motivates company executives and management to maximize the value of the shares. So in summary, they say that they're both avid capitalists, but they recognize that capitalism practiced as pure shareholder capitalism is flawed. This does not mean that we should fight capitalism or abolish it in some other possibly untested economic system. Capitalism has been the most successful economic system in history. It's created more wealth and lifted more people out of poverty than any other economic system. We do not need to abandon capitalism. We need to reform it to make it more inclusive. Because if we do not, societal trust in capitalism will continue to decline, environmental impact will be too large for us to recover from, the attacks from the populist left and populist right will increase towards our governmental structure and economic structure, and eventually the opponents might break down our economy, which would cause significant harm for billions of people worldwide. So in summary, there's really a two-point conclusion. You need to keep the environment healthy enough for life to go on planet Earth, and since capitalism is such a great economic structure and provides so much wealth and freedom, you need to keep it in a place where most actors in society can be happy with how it stands so that they don't try to tear it down. Now here's my 2 cents. I think a lot of what they're saying makes sense. One of the very common themes that comes to mind for me when I hear these authors talking about maximizing value of stakeholders, specifically talking about employees of companies, is when I've heard managers of very successful businesses speak on this topic. All over the place. I mean, if you go to any conferences, certainly on podcasts or YouTube channels, Gary Vee is a great example of this, you'll hear very successful business managers say that the reason that their business has grown so much, the reason that they're successful in life, is because of how much of a focus they put on their employees.
We are spending not enough time listening to our employees, our vendors, and our customers, but the place where you get the disproportionate highest ROI is when you listen to your employees.
As a business strategy, they say that they work for their employees. Their job is to make sure their employees feel like they have all the tools to get their job done so that the business keeps running smoothly and is able to grow. And then obviously, if your employees are really happy in the place they work, they're gonna work harder for you. You're gonna have longer employee tenure, which means people with more experience. So any customer that's dealing with your business is gonna have a better experience. And it's just gonna be a positive environment overall in the workplace. So that aspect of what I hear managers talk so often about really rings true in the argument presented in this paper when, again, they talk about maximizing the value for stakeholders, not just shareholders. But as a counter argument to that, one of the most successful businesses, if not the most successful business in the world, Amazon, notoriously treats many of their employees very terribly. So, maybe it's not all that important in some instances. Who knows? If you've gotten to this point in the video, thank you very much for watching the whole thing. The YouTube algorithm loves long watch times in terms of the total minutes you spend watching this or just a percentage of this video. If you haven't already, please don't forget to like this and subscribe to the channel. Like I mentioned earlier, both of those things help out a lot and I really appreciate them. As always, thanks for watching.